Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a look at what we are expecting to be moving markets this week, what sort of news there's been, and I'm going to be running through the charts and thinking about what might happen, maybe a couple of trade ideas. But I want to start here by taking a look at the calendar because there is a lot this week. So I mean, let's start off with the biggest events, right? We've got the Fed policy announcement on Wednesday. That is the number one event of the week. Okay, they're expected, as you can see here, to raise interest rates by 75 basis points for the second successive meeting. Who would have thought, even a couple of months ago when we knew that they had to be hawkish, who would have thought that they were going to be this hawkish and doing 75 basis point rate hikes for like consecutive meetings? But anyway, that's what we're expecting. And to be honest, the size of the rate hike, like everyone's pretty confident it's going to be 75 basis points. There is a risk that they could go 100. Markets are still pricing in a small possibility of that because do you remember a couple of weeks ago, just after the Cpi data came out, or about a week and a half ago, we started talking about a possible 100 basis point rate hike because remember that inflation data did surprise to the upside, or the headline did anyway. But since then, you know, we've calmed down on that 100 basis point rate hike idea a little bit because other data's come out and suggested that the US economy is weakening, like the PMIs on Friday. Global recession fears have also got worse, with things looking worse and worse for Europe in terms of like the data. And even on the inflation front, inflation expectations seem to be coming down from their peaks, and core inflation, as shown by the CPI data like earlier on this month, is coming down slowly, still high, but you know, it doesn't seem like the Fed is going to need to do 100 basis points. But anyway, I'm waffling. The main thing with the Fed, because we're expecting this 75 basis point rate hike, is what does Fed Chair Powell sound like in the press conference? What's he saying when it comes to the outlook for future rate hikes, and how does he view the economy at the moment? And I'm going to go through the charts in a second, but risk appetite has improved in the last couple of weeks, and it seems that markets are sort of pricing or positioning for a Fed that's going to be a little bit less hawkish than perhaps we thought they might be like a month ago. Okay, maybe Powell's going to be starting to sound a little bit more concerned about the economy, a little bit less concerned about inflation, and that combined means a slightly more benign interest rate hike outlook. So if that is what we get, you know, it might not be, but that could be supportive for risk appetite. But anyway, that's the Fed on Wednesday. Thursday, US GDP. Okay, this is also potentially, I mean, it's not as important obviously as the Fed because it is very backwards looking, but this is going to be a big talking point this week, guys, because we're expected to see 0.4% annualized rate of growth in the second quarter. But remember, look at this, we had a 1.6% contraction, annualized pace of contraction in Q1. If this surprises to the downside and we get a second consecutive negative quarterly growth reading, that means that the US is in a technical recession, which, I mean, you can imagine what the headlines are going to be like on not just the financial news, on all the news, US in a recession and all this kind of stuff. And that potentially, I mean, it could potentially damage sentiment, but then at the same time it could potentially dampen the outlook for Fed rate hikes, which could then support sentiment. But it's just something to be watchful for, guys. One of the things that a couple of people have been pointing out is the fact that, yes, there is a risk that this data is going to show that the US has been in a technical recession, but the way that recessions are usually defined is things like a rapidly rising unemployment rate. I mean, that really is the main other thing, and a crash in the housing market, which we haven't really seen either. But basically, yeah, like the labour market's still strong and the housing market is cooling, but it has been strong up until, you know, the start of the year. So even though it might show that the US is in a technical recession, like things haven't been that bad this year. I mean, the main thing that means that the US might be in a technical recession is the fact that energy prices and food prices and other things have gone up so much that it's just eaten into consumer spending power, which we've seen the influence of that on like retail sales, which have been getting pretty ugly recently, and consumer sentiment survey data in the last couple of months. It's all been very ugly, but things will be looking really bad for the US economy when you start to see the labour market turn. I think that's the thing that you need to be looking out for, which we haven't had yet. But anyway, enough waffling about the US. We've got some other key events as well, such as on Tuesday, okay, CPI data out of Australia. If this does surprise to the upside, which it might because the New Zealand one recently did, then you could be talking about a more hawkish RBA, which could provide a sort of short-term boost for the Aussie. Although the thing is, with the Aussie and the Kiwi and, you know, the Loonie and all these other smaller G10 currencies, they're taking their cue much more from like macro themes at the moment. So the Aussie is more, how the Aussie trades this week is more going to be a determinant of risk appetite, pretty much, you would think, and like commodity prices. Same with the Kiwi, same with the Loonie. What else have we got later in the week? Eurozone Cpi as well. Now, we've got a data-dependent ECB. Remember last week they hiked interest rates by 50 basis points and pretty much abandoned their forward guidance. It looks like it's a toss-up between 25 basis point rate hike and a 50 basis point rate hike in September. And it's data like this, CPI data, between now and September that will determine whether they go 50 again or 25. So that means that the euro could be, and other asset classes like Eurozone debt, could be quite choppy on this kind of thing. US core PCE, obviously inflation story in the US, really, really important, so we'll be watching that. Hopefully that will show further signs of moderation in core price pressures, which could further ease US inflation concerns, which could then in turn be good for risk appetite. But obviously that's the positive scenario. It's not necessarily going to go down that way. Canadian GDP, worth watching. And then, yeah, look, on Tuesday we've also got some consumer confidence data. Obviously, I was talking about how US consumer confidence already pretty weak, so we're just expecting that to not have changed, basically. Charts. Let's quickly go through what I'm looking at. Now I've been waffling so much about the calendar. S&P 500. So we had it the other week. Since the start, you know, we've had a decent start to the earnings season for the most part. Bit of weakness in social media names on Friday, but before that it's been all smiles. And we broke above this downtrend that we were in, okay, and above the 21-day moving average in blue, 50-day moving average. So really, from a technical perspective, I think things are looking good for the S&P 500. I think there's the potential that we can get a test of these highs from the end of May around 4,200 and a break above 4,000. Obviously, a lot of macro events this week that we've just been going through, and that all needs to go well for this to happen. The other thing is we've got a lot of earnings this week from some of the biggest companies. So what have we got? We've got like Apple, Amazon, Microsoft, Google, and then we've got like Coca-Cola and McDonald's, I think, as well, and plenty of other big US corporate names. So hopefully, you know, if you're a bull, these earnings continue to come in better than expected, as they have for the most part so far. And yes, if all goes well, I think we can hit that 4,200 mark fairly quickly, you know, within the next week or two. I don't know, we'll have to see. Let's just look at the Nasdaq as well real quick. US tech. I mean, these are all CFDs that I'm looking at, as you guys can probably imagine. You can see that the Nasdaq has actually almost hit those highs from late May, early June, and it's kind of the same story as with the S&P 500. If all the macro and the earnings continue going well, it looks like we can get to that level. And this level, by the way, for the Nasdaq's actually been a very important sort of balance area in the past. Okay, as you can see, it was support, then it kind of has turned to resistance. And I mean, it's a bit messy around here, but it's pretty much around 1,300. 12,800 to 13,000. Sorry, not 1,300. But if we can get above that, you know, door is open for a rally up towards this 200-day moving average. What about currencies? Let's start with Euro dollar. Currently trapped below that 21-day moving average and within recent intraday ranges. We've been having data recently, a lot of data recently, like German IFO data this morning, ugly. Eurozone PMIs last Friday, ugly. So that, you know, Eurozone economic recession is kind of being more and more priced in, which may be capping the upside for now. You know, if we do get risk appetite this week, though, there is the potential for dollar weakness because the dollar's a safe haven, which could boost this further, which means we could get back and test this 103.50 area. You know, I've kind of been calling for a test of that for a while. But then remember that we do have this downtrend, which has been in play. I've been talking about this for a while as well, And, like I said, Eurozone economic story pretty ugly. ECB not going to be anywhere near as hawkish as the Fed when all things are said and done. I still think that's probably a good area where we could sell and head lower. Let's have a look at sterling real quickly as well. Also sort of in a downtrend, as you can see here. Let me get that a little bit better. Yeah, I mean, pretty much. Although sterling has today managed to get above this 21-day moving average, and like I say, if risk appetite continues to improve, you know, maybe we can get above that this downtrend and push on towards the 50-day moving average, which is around 122.50. What else we got? Oil, last asset we'll look at, and then we'll wrap up. I'm quite interested in oil at the moment, and I'll explain. Again, we're testing this 200-day moving average. Again, we've bounced, but for how long? Because look, we're still in this downtrend, which has been respected pretty well over the last couple of weeks. All the things we're talking about regarding the global economy are about how we're moving more and more towards a recession. You know, like the data last Friday, the PMIs out of the US, UK, Eurozone. It's all weakening economies. The German IFO data this month, it's all pointing to more weakness in these major economies. When we're sort of probing this key area, it's not just the 200-day moving average, it's also these lows here from March and April. And if we break below it, I think there could be a bit of a cascade of selling pressure that will quickly take us back to this next area of support. And just another thing to add, keep an eye on this in oil, because if we do break lower and drop like 10% or 15% towards the mid-80s per barrel, that could boost risk appetite, because a lot of people would probably start talking about how downside in global oil prices are deflationary or sort of reduce the risk of inflation remaining elevated. So, yeah. Just something to keep an eye on, because if this happens, then, you know, it could help equities. But anyway, guys, that's the video. That's my week ahead. Hope you enjoyed it, and I'll see you all in the next one.